Good afternoon, everyone, and welcome to today's webinar, How the Australian Dollar's 19% Moves Can Drive Your Business's Highs and Lows by Stephen Dooley from Western Union. Today, you're listening in using your computer speaker system by default. If you would prefer to join over the phone, select telephone in the audio pane and the dial-in information will be displayed. You'll have the opportunity to submit questions to Stephen by typing them into the questions pane on the control panel. However, some may be answered individually after the webinar. To give a brief introduction on today's presenter, Stephen Dooley is the Western Union currency strategist. He has worked in financial services for more than 15 years, originally as a journalist, then in a global institutional investment firm, and then made the shift into financial analysis. His role at Western Union Business Solutions is focused on helping staff and clients understand what's driving financial markets and how it might impact on Australian businesses. Stephen makes regular appearances on Sky Business and has also been interviewed on the ABC's Late Line and News Breakfast programs. He has written regular columns for Melbourne's Herald Sun. Stephen has a Bachelor of Arts graduate diploma in Applied Finance and is an accredited member of the Australian Financial Markets Association. I'll now hand over to Stephen.
Thanks very much for the introduction, Kate, and appreciate the opportunity to speak to everyone today. Look, as Kate said, my role here at Western Union is to help our clients who are majority importers, certainly all businesses with foreign exchange exposure, and help them to manage the almost guaranteed wild fluctuations that we see in the Australian dollar. The Aussie dollar versus the US dollar pair, for example, moves 19% on average each year. That's an incredible move, and it means that the cost of your goods can swing by up to 20% per year, regardless of what your underlying business is doing at the time. So that's really what we try to do here at Western Union, is first of all, help our clients really recognise the incredible impact that the Aussie dollar's volatility can have on their business, and then second of all, show our clients ways that they can protect themselves from the market moving against them, provide them with certainty and confidence about their business costs and cash flows, and then for other businesses, show them ways of being able to protect themselves but still benefit from the market if it moves in your favour. Think if suddenly your cost of goods fall by 10 or 15% over the course of a few months, and you've got the ability to benefit from that, that can have an incredible ability to boost your business and your profit. So really, that's what we try to do at Western Union. So first of all, Kate's already introduced myself, but as she said, my name's Steve, and I'm the currency strategist here at Western Union Business Solutions. Now, we'll try to go fairly quickly through these slides, but what we'll touch on today, we'll talk about who Western Union is. We'll talk about some of the big economic drivers in markets at the moment, which is really about the US Federal Reserve and their plans to raise interest rates again in December. That's seen the Aussie dollar fall from 81 to 76 since the Federal Reserve came out to say that that's what they plan to do. Clearly the biggest impact in markets. And then finally, focus on that risk management side. That's really when we're talking about how that Aussie dollar's 19% move on average per year can have a massive impact on your business. But who's Western Union? Well, we've been in the business for 165 years. We're the world's biggest non-bank financial services firm. And of course, we started off putting telegrams through the Wild West in the United States back in the 1860s and 1870s. We progressed and evolved to now where we're still focused on delivering information to remote areas very quickly and effectively, but now it's money transfer rather than telegrams. So you can see the clear evolution of the business, and the division that I work in is the business-to-business payments side of the business. And of course, our expertise in transferring money, very easy to also use that in the corporate and SME space. And that's what we do here, help our clients make payments to their suppliers to receive income quickly, effectively and correctly. and also, as I said, help them manage those wild fluctuations that we see in currency markets. But what I've been talking about recently, seeming we're near the end of the year, it's really interesting, I think, to start off by looking at where we started the year. And you can see that at the start of the year, this is the Reuters foreign exchange or FX currency poll about where analysts around the world think the Aussie dollar, what they thought it was going to do this year. And you can see that the vast majority of analysts all thought the Australian dollar was going to fall throughout 2017. That just didn't occur. Instead, the Aussie dollar's had a very rapid rise, and just in the last couple of months, trading up at 2.5-year highs. So, what was the real driver of that unexpected move? And you think about why everyone thought the Aussie dollar was going to fall. Well, as I said at the start, expectation that the US Central Bank, the Federal Reserve, would raise rates. The Australian Central Bank, the RBA, wouldn't raise rates, and in that environment normally causes a currency to press higher. So that was why the majority of analysts thought the Aussie dollar would head lower. Why didn't it head lower? Well, of course, no real surprise, all thanks to the election of Donald Trump. And you can see the big moves lower we saw in the US dollar this year, whether it was his first press conference that was light on detail, whether it was when Donald Trump said that the strong US dollar is killing the US economy, the inability to get that healthcare bill through, or the sacking of the FBI's James Comey. All of those factors have sent the US dollar lower, and that's why, again, no one really expected Donald Trump to win the presidency. No one expected these unexpected events to occur, and you can see why the very best forecasts from the best analysts in the world, the vast majority completely wrong. Why? Because unexpected events occurred, and it's probably no surprise to you if you're running a business that unexpected events occur all the time. But that's the reason why this year we had so many analysts completely get it wrong. And you can see here the net result, as I mentioned earlier, Aussie dollar jumping higher this year and trading up towards 2.5-year lows, quickly turned back lower. And again, that's what we were talking about at the start, how quick the market can move, fallen from above 81 cents to 76 cents in the blink of an eye just the last 6 or 7 weeks. But more importantly, you can see the Aussie dollar's had this big swing higher over the last year or so. And for importers, that's a really big opportunity to take advantage of that, particularly, as we said, the majority of analysts thought we were heading back towards the low 70s. Most businesses have budgeted in the low 70s, so the push higher really provides opportunity for businesses to lock in some foreign exchange gains that they might not have ever thought were likely this year. The other reason the Aussie dollar's had a good year this year is that all of a sudden economic growth has returned. And it's been the last 2 years after a very dire period in financial markets after the GFC. Really, markets seem to have picked up. It was only just over 18 months ago that the global economy was in a very negative state, but a big Chinese stimulus program boosted growth in China. And you might remember start of 2016 was worries about China that were really driving markets. But a rebound in Chinese growth was quickly followed by an improvement in global markets as Donald Trump won that US election. And suddenly, over the last year or so, we've seen Europe, Japan, and the US even all see a much better improvement in economic growth. And these latest data from the IMF shows you that all of a sudden expectations for growth this year up at 3.6%, and anything over 3% is typically seen as a great result, and 3.7% predicted for next year. So that's the other big theme that's been helping the Aussie dollar higher this year. First of all, as I said, uncertainty around the US dollar caused the US dollar to weaken, but better news from the global economy has seen the Australian dollar push back higher. But As we also said, the Aussie has fallen in the last month or so. What's been the driver of that? Well, it's the risk of higher US interest rates. And ever since that last Federal Reserve meeting we had just 6 weeks ago, the Australian market has turned quickly lower. And that's because typically higher interest rates causes the Australian dollar to fall back lower. And as I say, on that 21st of September, the Federal Reserve said they are now planning to raise rates one more time in 2017 and 3 more times in 2018. And in fact, overnight, the Federal Reserve continued to say how much better the US economy is. They upgraded their view from moderate growth to solid growth. So that just makes the chance of a rate hike in December even more likely. The risk of an Aussie dollar move lower, as I say, also more likely. And that's particularly true if the Reserve Bank of Australia doesn't raise rates. And as we saw last week, a weaker than expected number from the Australian inflation has really seen any chance, at least according to the market, any chance of a rate hike pushed out now into 2019. So a big sea change from those two factors. And as I said, that's the real big driver of that recent weakness. All of a sudden, the US looks like they're going to raise rates. Australia doesn't, and that's why we've seen the Aussie dollar fall from 81 to 76 in a very short time frame. And of course, the other big story that we're likely to see over the next couple of days is to who's the new head of the US Federal Reserve. And if you wonder why we talk so much about interest rates, this chart here shows you in white, that's the difference between Australian interest rates and US interest rates, and in orange is the Australian dollar rate. And you can clearly see as the difference between Australian rates and US rates gets smaller and smaller, the Australian dollar gets weaker and weaker. And certainly at the moment, as we said, over the next 12 months, if the US continues to raise rates, if the Australian dollar doesn't raise rates, then you can see that white line fall back lower, and that will see that orange line fall back lower as well. And then just finally talking about US interest rates, the next big story, of course, is going to be who's the next Federal Reserve chair. That big news is coming over the next couple of days, possibly as soon as tonight, and it certainly seems like Jerome Powell, the chap here at the start of the list, now looks most likely who will be the new Federal Reserve chair. But really big factors coming through on the US dollar over the next couple of weeks. First of all, who's next in the Fed, but also Donald Trump's tax plan will create some big volatility. So, as I say, after a very good run over the last 12 months, Aussie dollar seems to be weakening, and stories like the who's next in the Federal Reserve chair, how Donald Trump's tax plan goes, will be that big driver out there. So, just quickly thought I'd show you how that market has played out over the last few months. You can see really here the Aussie-US, probably the most closely watched market after being a very long weakening phase for the last 5 years. All of a sudden had this good run for most of this year, now appears to start to be weakening back lower again. And so that's why most analysts at the moment believe we're going to have a bit more of a move lower. Probably the most simple way of analysing markets is using a moving average that we have in blue here. And you can see when the moving average is pointing lower, the market tends to fall. When the market moving average is pointing higher, the market tends to rise. And you can see here, moving average just starting to point back lower in a sign that all of a sudden the Aussie's good times might be behind us in the near term. Similar story on the Aussie Euro. And of course, over in Europe, they're not raising rates yet, but they're ending their money printing program. And that's what's caused the Aussie Euro just to fall so sharply this year. It's been a big turnaround, and you can see that really occurred in the second quarter here, where we fell from up above 73 down to 65. Again, what we want to point out to you is how quickly these markets do turn. They don't fall, if they tend not to move for a while, and then when they do move, it's very rapid. You can see this market had just been slowly grinding higher for a year, then all of a sudden gave back that whole year's worth of gains in just 2 or 3 weeks. That's the way the market tends to go, and the current market tends to point a little bit lower. Aussie pound, it's a bit of a similar story. The Bank of England looks like they're ready to raise rates this, tonight actually. That can see a little bit more weakness on the Aussie pound, but over the medium term, worries about Brexit should cause the Aussie pound to lift higher as the British pound weakens. The Aussie yen, if anyone's involved in importing from Japan, currently looks a little bit more positive. The Bank of Japan are currently keeping rates very low in negative for the foreseeable future, and that can see Aussie yen continue to press higher. And then finally, the Aussie versus the New Zealand dollar had a huge move, very close to 4-year highs after the New Zealand election was seen to give power to a Labor, Greens and New Zealand First coalition, and that's seen for any Kiwi buyers move right up towards 4-year highs, a big opportunity. And then on the Australian dollar versus the CNH, the Chinese yuan, you can see after a very good move higher for most of this year, that market starts to look a little bit weaker as well. So really, it seems like, as we say, ever since the 21st of September, when the Federal Reserve said they would raise rates once more in 2017, 3 more times in 2018, that seems likely to, what seems to have really pressured the Aussie dollar a little bit. So it's a perfect time to sort of think about, where market expectations are, and really you can see the forecasts are anywhere from 71 to 90, and then you start thinking about, well, with my business, how can I best, consider what the impact of the Aussie dollar might be? And what I try to say is think, well, how will my business behave if the market goes up to 90 cents? We think, well, that will be a fantastic result. How will my business behave if it goes back to 71? Well, it's probably going to be a very negative result. So that's why looking at those two, the forecast range from investment banks all around the world provides a really good guide to thinking about how you can manage your foreign exchange risk management. So that's really the crux of what we're talking about today. And as I said, Australian dollar very volatile, 90% per average each year, and it tends to move very much in lines with share markets. So when people are feeling good about the world, Aussie dollar goes up. When they're feeling bad about the world, Aussie dollar goes down. So 19% per year, very, very volatile. So how do you manage this kind of volatility? Well, we believe in using what we call the risk management cycle, and it has 4 steps. It's very simple. And first of all, you identify your goal, what you're looking to do, whether that's trying to achieve growth, whether it's trying to protect your margins, whether it's cost control, whether it's trying to benefit from a market that moves in your favour. Having an understanding of what you're looking to do, absolutely crucial. Then make sure you've got that visibility of your exposure. And a lot of businesses don't realise if they're making a $100,000 payment each year, they're not sort of each month, they're not conceptualising that as $1.2 million per year. And as I said, in that 20% move or that 19% move, that equates to just having around about $250,000, $250,000 just floating in the market. You completely got no control over it, and so the risk of making a $250,000 FX gain or the risk of making a $250,000 FX loss, an incredible risk out there. And once you've got that visibility and understanding of how much that risk is, much better idea of how you can manage that risk. And then it sounds simple: implementing the plan, having the plan in place, implementing it regularly, and we'll show you how to do that in a moment. But regular implementation of that plan makes it operate like clockwork, and it's just one more procedure in your business that makes sure that you're taking advantage, that you're managing risk in a considered way rather than reacting to the market. And then you regularly review the plan and regularly review that plan and go back and make any changes that you might need to. And the plan normally ends up looking like this, and we call this the rolling hedge. And basically, what you do is, for example, and every business is different, but you might be hedged around 80% of your cover for the first 6 months. And then further out, you might have a smaller hedge. And what this just does is protect yourself from any unexpected moves. And like I said, Aussie dollar at 76 now. You can think, well, these are the payments we need to make at 76. A quick move back to 70, all of a sudden, really changes what that means for your business. But having this hedge in place means that you're knowing that you're going to pay 76 for the next 3 months, next 6 months, gives a lot more certainty, a lot less risk in your business. And then each month, you just what we call top it up. And so you can see here, January through December. As January passes, what you do is you add some to month 6, and then you establish some in month 12, and do this every month. And you find that's a gradual way that you hedge incrementally, and you reduce the risk out there in your business. So that's a very simple way of thinking of how to use a simple hedging plan. And then we just think it comes down to what the kind of business that you are, the kind of client that you are. And there are 3 kinds of clients that we sort of then use that classification to decide how you're going to try and manage your foreign exchange. And the first class, protect. And that's where you think, all I want to do is make sure the market doesn't fall and doesn't impact on my business. The second classification is, well, people that are looking to take advantage if the market moves in their favour as well. So I'm willing to give up a little bit of the protection rate so that if the market moves in my favour, I can still benefit from that. And there's a third classification, which we're not really going to discuss too much today, but that's the enhanced classification. That's where you might be looking to do something a little more sophisticated to try and achieve a rate that looks more attractive for you. But we're not really going to focus on that today. We're going to look at those protect and those participates. And the protect really ends up using what we call a forward exchange contract. They tend to be at a rate that's fairly close to the market at the time. And they mean that, for example, if you have a 3-month payment that you need to make, you get it forward, you lock in the rate, and you know in 3 months' time, that's what you'll look to pay. So you're protecting yourself against that risk in the most simple product that we have there. And many of you may have used that before. It tends to be, as I say, the cheapest, and it tends to provide you with protection against the market that moves in your favour or against you. The alternative is what's more like an option product. And the option product that we've got here is a participating forward. And this differs insofar, this is for clients, as we say, who think, well as protection, I want to take advantage. If the market moves to 85, I want to reap that FX gain. And by doing that, you use what's called a participating forward amongst a number of other currencies. And what will happen there is if the market moves lower, in this example, you'll be protected at 76.20. And you'll know, and as you'll see, rate a little bit worse than the previous rate, which was on the forward, 77.20. But the participating forward, the rate, a little bit of give up, but if the market moves higher, then you'll be able to deal part of your exposure at a better rate. So you can see here what we're trying to do, how we're trying to present that. Protection just offers protection against the market falling. Participate offers protection against the market falling, and also the opportunity for a move back higher. So as we said, what product you should use, it's down to the kind of business you are and what you're looking to achieve with your business. But they're the 2 main categories that we look to resolve. So look to help you manage. So really, that's what we're looking to do, and that's what we do here at Western Union, is help clients, as I say, understand how volatile markets are through a number of different services, including our Edge transactional software, which allows you to log on and have an understanding of of what your exposure is, as well as being able to make payments, but it helps you understand the exposure and understand the impact that can have on your business, and then provide ways of showing you how to manage that foreign exchange risk, so that it's just one more way of creating certainty in your business, so you're not held hostage by the market's movements, which of course, as we showed you earlier, no one can really predict. So if there's anything I was going to leave you with today, is to think about the fact that having any exposure to making overseas payment means that there's a big uncertain part of your business that we just don't know how it resolves. So FX markets are always moving, and we just don't know what we don't know. We don't know where the market will be in 12 months. So what Western Union can do is help you. Even though we can't tell you where the market is, we can tell you where your payment will be by using that ability to manage that risk. So if there's anything I'm going to leave you with today is think, first of all, FX volatility is part and parcel of your business. Aussie dollar, on average, moves 19% per year. You need to accept that's going to happen. You know, it's happened on average every year since 1983. Have a plan that can withstand the unexpected, because markets always move in unexpected manner. You think about Donald Trump's win this year at the US, or last year in the presidential election. No one predicted it, and everyone who said they weren't able to predict it said that share markets around the world would collapse if he won. Well, he did win, and share markets around the world are up 30%. So have a plan that can withstand the unexpected. Be prepared for events, even if it will never happen. And we talk about the Fed announcement tonight, the new Federal Reserve Chair. They can have a big impact on markets, and by being smart ahead of that, you can potentially put orders in place, take advantage, get a better rate. And as we said, hedge incrementally and consider a blend of products. There's no silver bullet. No one knows where the market's going, but by taking an incremental approach and diversifying your risk, foreign exchange risk is like any other risk in financial markets. Diversification and a cautious incremental approach will usually pay dividends. So these are the simple techniques that we hope to be able to bring to businesses, and certainly hope that we can bring to your business today. That's it for me today. I'd like to thank you all for coming. Of course, please make note of the disclaimer on this final slide just here. But I'll finish up with my my contact details. And of course, if you want to make a phone call or send me an email, please let me know. More than happy to help. And I hope today's presentation has been helpful. And with that, I'll pass you back to Kate. Thank you, Kate.
Thanks, Stephen. That was fantastic. Just have a look at the questions. There aren't any yet. So if anyone does have a question, they can send it through right now or contact you on the details that are on your screen. Nothing's coming through so far, so maybe everybody's shy. All right, well, we might leave it there. Tomorrow you'll receive a follow-up email with a link to view the recording of today's webinar and a link to view Stephen's slides. So on behalf of Stephen and APA, thank you all for joining us today, and have a great afternoon.
Thank you, Kate.